We are here on episode 26 of the Capital Spotlight podcast. Your host, Craig McGrother, the Director of Business Development here at Lone Star Capital, alongside the man, the myth, the legend, two-time author, co-principal and founder of the incredible firm Lone Star Capital, the one, the only, Rob Beardsley. How are you today?
I'm feeling great. How are you?
Incredible. It's sweater season here officially
Yep.
in Scottsdale, Phoenix, Arizona, as I chase good weather. It's a little nippy here, but it's okay. We're surviving and thriving. Days a little bit shorter, but it's grind mode officially. No rest for the wicked here as we go into um, a break potentially coming up with the New Year and Christmas and other holidays and festivities. So we're busy as ever, and I love it.
It's an exciting time, no doubt. There's a lot of things happening. The market's moving, rates are moving. I mean, I don't even think this was on our agenda, but I mean, you check rates and rates are down 20 bips today. Stock market's ripping. The Fed came out and talked about the potential for three rate cuts next year. The market doesn't believe that and thinks there's going to be six. So the market's going crazy. So yeah, that's everything's happening quickly.
Soft landings, one could only hope for them, right?
Yeah.
With that said, before we get into the show and the meat and potatoes, if you're a capital raiser looking to partner with a group like us, please reach out to me. We'd love to break down why Lone Star Capital to you if you didn't already know why from listening to the show. So if you're a fund manager, you have a 1031 exchange, you're looking to partner with us in any capacity, if you're looking just to make an LP investment, please reach out to myself, Craig at lscre.com. If you're looking for the fund to fund program document, and our webinar that we did on that, we can point you in the right direction. Email me at craig at lscre.com. If you have any questions, comments, or concerns regarding the show, email me here at craig at lscre.com. Just want to make a quick shout out as well with our travel plans coming up. This should be coming out, I believe, on the 17th,
It'll
18th.
be the 18th.
Gotcha. Well, we'll be in Houston on, I believe, the
January
8th.
8th.
January 8th to the 10th, and then San Antonio the 10th and 11th. So would love to see you there if you're in that market. Reach out to us. We'll be at NMHC in San Diego at the end of January, and then we'll be at Raise Fest as well in February. And then I'll also cut back to January. I'll also be in Laguna Beach for the IMN select conference there at the
Yeah,
Montage, which
what's
will be
that? The
fun.
IMN Private Fund Forum or something like that. It's a really good show, so definitely excited for you to go there. But frankly, I feel like we have so many good partners that we're talking to right now and so much momentum with our investors that I don't really want to myself or have you go to conferences to this sounds bad to say, but I don't really want you to go necessarily hunting for new investors. I feel like we have so many good existing ones. I'd rather deepen our existing relationships rather than run around conferences trying to chase people down. I know that's part of the job, but it feels a lot better when people chase us, right? So
Yeah, well, and funny enough, we've had more conversation, or because I'm kind of more gatekeeping on this, and you guys have been listening to my call to actions. I've been doing a lot of the gatekeeping on this, and I just can't really thank everyone enough who listens to the show. From the bottom of my heart, thank you so much for A, for listening, but for B, actually reaching out to me, calling me, texting me, partnering with us. I just was on a Zoom for 40 minutes prior to this conversation with a really, really sophisticated group of guys in the Midwest area. They're awesome. And then we're also working with a big LP investor of ours who will be investing a large chunk of change that has also been listening to shows. So maybe you know you are, maybe you don't. But shout out to you guys and just keep the messages coming. This is legitimately the best medium that I could think of. In the sense of getting our message out and finding people that are like-minded and good fits to work with. So just a thank you, keep it coming. And once again, if you want to partner with us, if you're a fund manager, maybe a co-GP, even though that's a little obsolete. If you got a 1031 exchange coming up, reach out to your boy, Craig, Craig at lsre.com. Now on to the meat and the potatoes of the show. Before I ramble any further, episode 26 here, we're going to talk about why Class A product now, A minus A, the importance of having a moat in your business. We'll finally get to that. We've pushed this off for a couple shows. Brokers pursuing lender relationships. I just did a 3-day fast, and then we'll also be debuting a piece, a very, very beautiful watch. If you want to tease it real quick right now, we'll go through that.
That's
Yes.
all for now.
Awesome. So why Class A product right now? It's very exciting. We are, of course, seeing cap rates widening, and we're seeing opportunities right now where we've got so many cool options to potentially buy, but there's only so much we can inevitably buy. So Class A is looking oh so appealing when you factor out the risk reward, maybe the lack of work that needs to be done for the yield that we can create. So do you want to kind of get into why we're looking at this product as opposed to maybe a deeper value add play with a little more, I guess, inherent risk on the business plan?
Yeah, I think there's a few key concepts as to why not necessarily true core A product, but good quality assets are the place to be right now. So, number one, the first thing is, and I do believe this will change, and I've been saying this for a long time, but a lack of price dispersion across asset quality. So, we've been talking about this for a long time, and this has been true for a while. An A deal would trade for a similar cap rate to a B deal, and a B deal would trade for a similar cap rate to a C deal. Now, the fundamentals and the upside might be different, but it's a pretty simple equation where if you can buy three different things that are A, B, C in quality and they're roughly the same price, why wouldn't you buy the highest quality? Right. So that is a pretty straightforward concept. And we're seeing that apparent in the market today. We are historically not core plus buyers because we cater to investors seeking mid-teens to opportunistic returns. And core plus real estate is incompatible with that high of return because the reality is if you want to achieve mid-teens and above returns, meaning a 15 or a 20% IRR, you have to take some risk, right? That return is not free. And core plus is generally considered to be very low risk. And so it's hard to generate high returns with low risk. So however, where we're at right now is a very unique period of time where there's market dislocation. A lot of people are on the sidelines. And so we're actually seeing the opportunity to buy core plus real estate that is low risk, that historically would only afford you a high single digit return, but now you can actually solve for a mid-teens return on that quality product on that low risk. So that is kind of the headline, and that's the really exciting feature. But there's a lot more to it. The next piece, which I think is probably the second most critical, is financing, right? We always talk about debt. We talk about how debt is the greatest source of risk in real estate. And right now, in my opinion, for multifamily, the agencies, meaning Fannie Mae and Freddie Mac, are really the only game in town because you have bank debt, you have bridge debt, but those products are priced so much more expensive than agency. It's hard to justify, right? Your deal has to be so good. There has to be so much upside in your deal to justify the extra cost of a bridge loan. So I think bridge is out of favor. Moderate leverage, fixed rate, medium term agency. I think that's the place to be. I know you know this, but and from who we've talked to in the industry, 5 year term agency debt is some of the most popular product right now. You can get a fixed rate loan, which is attractive from an optics and from a safety perspective. You can do a 5 year term, which is long enough to be conservative, but not too long to lock you into yield maintenance forever. So it's a nice sweet spot. I mean, everyone feels like rates are coming down, so it's kind of a shame to lock in your fixed rate. But if you're only locking it in for 5 years, it's not the end of the world. You have light at the end of the tunnel where you can refi. So that financing equation is really critical to this strategy of as we're talking about why class A or why core plus real estate over value add or opportunistic. So the debt's really critical. And the reason why this matches well with Core Plus is because the agencies are a good fit for stabilized real estate, not generally that great for value add because if a property has high vacancy or collections problems or crime, it cannot be a fit for agency. All right, that's a fit for a bridge loan to transition that asset into permanent financing. So, but if you're buying a clean deal that's stabilized right off the bat, then you can go in and finance accretively with agency debt and actually get good leverage because you have enough in-place cap rate to go ahead and do 70, 75, and even 80% LTV. And that really makes the deal make sense when you have positive leverage.
So this deal compared to other opportunities in the past is pretty special. So, or just deals right now in general with, I was thinking about the one specifically, but the deals we're seeing right now are special because we're seeing cap rates that are pretty high for really high quality, but we're also at a really potentially a very small sliver of time here where we've got, core plus properties that are positive leverage. So obviously, as we've gone over the show dozens of times, interest rate higher than, or sorry, cap rate higher than interest rate, we're seeing a spread there, which is probably something we're not going to see forever.
No, there's only going to be a window of time there. And I think for when you're talking about really quality institutional quality product, and like the deal that I know you and I are thinking about that we are putting under contract, right?
Which, by the
Very,
way, if you want to have more access and insights and access to our deals, email me, Craig at lscre.com.
yeah, that's the sales pitch, right? So we can't say much, but it's happening. It's exciting. So a deal like that, right? That's really high quality. I would say the best you can expect is maybe 150 bips of positive leverage going in. That's like end of the world. That's 2008. That's the that's the best you can expect, right? When the market is as dislocated as possible. 150 bips. So, we're buying this deal for 50 basis points of positive leverage. That feels pretty good. That's not going to be around forever. Could the spread widen over the next? I mean, it just widened today by 20 bips, frankly, given how the treasuries dropped. So, could it get better? I think it will. I think over the next 6 months, I think spreads are going to continue to widen. So, is it possible to buy really quality deals for with 100 bips of positive leverage spread? I think so. And I think that's going to be really, really an exciting time. And it's not going to last very long. So, one other thing I want to go back to that you mentioned, which is really important for us specifically, is the return on headache or return on brain damage. Because while we've only so far been speaking kind of investment strategy and philosophy, there's also the practicality side of it. And the reality is, if we want to grow as a firm, if we want to talk about optimal portfolio construction for our investors and for ourselves, we have to consider how much of a headache a deal could be. And specifically, the deal that we're talking about buying right now, that's a clean, beautiful asset. Neither of us would mind living there. It's got a beautiful pool and amenities, right? So that deal runs itself, right? We're not going to have a hard time running that deal. It's going to be very low risk from an execution standpoint. So the likelihood of us falling behind on our pro forma, having to answer to our investors and having problems there from an operational and then cascading investor relations problems, all that is very unlikely. All right, it could happen. I mean, obviously, there's no guarantees in this business, but it's unlikely. Whereas if you take on a project where you have to raise occupancy, you have to re-tenant the property, you have to fix the crime issue, you have to raise rents, you could get behind on your pro forma, which causes more strain on your asset management team. It causes more strain on our investor relations team because now we're working harder to communicate more, right? Because in good times, we communicate to our investors. In bad times, we over communicate to our investors. So it's all in all more work, right? And we need to be
Well, also in
paid for
good
that.
times, investors don't even ask. They just, go with the flow.
That's right. That's right. Absolutely. So all that is all that means we need to be conscientious of where we allocate our resources and making sure that if we're going to go and let's say have the opportunity to buy a lot of great deals at a great price over the next year, because that's what we think 2024 is shaping up to be. Do we want to buy a lot of deals that are going to be a ton of work? And maybe because of how much work they are, it slows us down and we end up buying less. So we actually get less exposure into this fantastic opportunity. I'm not saying there's one right answer, right? Because the converse argument is, well, if you dumpster dive and you buy the rougher deals and you pull it off, you'll probably end up at a higher IRR, which is great for our investors, but it's also great for us because we're going to hit a higher promote, right? The promote's going to be worth more on deals that are a heavier lift. So there is a compensation there, but as a sponsor, we need to be very very certain that when we get ourselves into a headache business plan, we're going to be compensated for it by not just by our time, but by the risk we're taking, right? So that has to mean that our investors are going to get a really strong return and that we're going to get a bigger promote than we otherwise could on a more down the fairway deal.
And as we kind of walk through this system or this, I guess, strategy as well, this blip of time, it's, kind of a couple of things. It's also defensive too, because it's not a, big imagination or imaginary to think that, hey, this deal will get, the rent growth projections there, that the occupancy will stay there, that a deal that's performing well will continue to perform well. You're not stretching beliefs there. We're not turning things around. So this is, it makes sense on a fundamental perspective when you factor debt to cap rate, but also on time put into an opportunity. And just, frankly, we do kind of serve and listen to what people want. And a lot of institutional groups right now, this is kind of what they want to invest in. And that's smart money that wants to deploy equity into kind of that A minus AA product right now. So, and also it's important to consider where that A property is located that you want to invest in. For instance, A class in a downtown area will likely get smashed with new product and inventory coming on. We've talked about this before, I believe, but Austin right now, to our knowledge, has got a massive amount of units coming online in that A space, which makes kind of A minus product, challenging because that will get downgraded inevitably. So if we are going to look at A, I think it is important to make the distinction that the biggest thing we're going to look for is, how much other A products in that area, what incomes look like. But on top of that, really what's to come online? Is there a bunch of supply coming up? Is there, deals on the pipeline that will, kind of downgrade our potential asset? So those are the nuances and things we think about in reference to the acquisition side that I think a lot of people don't necessarily just think about.
Yeah, that's a very good point. Supply is huge, especially when you're talking about buying in that 2000s and newer space because you really are more directly impacted by new supply. Even if you're buying 80s product, you're impacted by new supply, right? It all trickles down. But when you have new product or newer product, it is more exposed to new supply. So we pay double the attention to the supply pipeline. So
Yeah, and also too, something to think about is 5-year debt term. I hope that in 5 years the market will, be bouncing back and on the upswing, and we'll get rent pops and the economy's in a great spot. But if it's not, and we've got to hold this property longer than 5 years, or a property for longer than 5 years, a product is something we'll probably want to hold on for a little bit longer too, because we know it's such a nice asset. Than, kind of a junky deal that is a headache at all times. In addition to that, you have to think that you're going to get cap rate compression on A assets first. So likely this will be the last to get widening and the first to tighten. So that is another thing to think about. Would you say it's a fair assessment, Rob?
I agree. I agree, definitely. However, what's going to widen the most is the worst product,
Yes.
right? Because people are going to look at it as a hot potato and they'll go, well, why the heck would I own this when I can actually trade up to something nicer? And so it's really going to widen that Class C cap rate. But then once the market comes back, I'm not saying zero interest rates come back, but once rates come down and people get competitive again, the market gets competitive again, people are going to be overbidding Class C again. They're going to forget all about this, and Class C assets are going to be trading at a cap rate not too dissimilar from A again, right? So I do think there's going to that's going to happen again. But yeah, the A stuff is going to be the most resilient operationally through a recession, and then also from a cap rate perspective, also going to be most resilient. So it is something more attractive to hold. And just generally speaking, the longer you're capable and willing to hold, right, the longer your potential hold period, the lower your risk. You can make a Class A deal risky if you want to sell it in 2 years, right? Because you could just catch the wrong 2 years. But if your outlook is the potential to hold for 10, that's a very, very strong prospect of making money and not losing money.
What are the other benefits, would you say, associated with a product, not just now, but just generally speaking, compared to the other, I guess, options you have as a buyer for the multifamily space?
Yeah, there's some notable factors when it comes to construction quality. There's a big step between 70s and 80s, and there's also a step from 80s to 90s. Not as much was built in the 90s because of the S&L savings and loan crisis, but then there was a lot of product built in 2000s, which is a step above, of course. But before I dive into that too much, I'll tie it into another concept that is making today a particularly interesting time to pursue institutional quality Class A assets. And that is the way that institutional groups are disproportionately on the sidelines as compared to private capital. If you talk to private owners and operators and syndicators, they still want to buy deals. They're only limited by their ambition and by how much money they're able to syndicate from their investor base, which
which is
is,
usually based upon their ambition.
yeah. And it's reduced right now, frankly, because there's less positive sentiment in the market and investors might be inundated with capital calls and they don't want to put new money out. So definitely, the rule of thumb that we're hearing in the industry as far as raising retail money is that if you could raise $1 million 2 years ago, you're probably only raising 300K right now. So scale that, right? If someone could bite off a $10 million raise and buy a and with strong leverage, that means that they could buy a $30 million deal.
Maybe
Now
they're
leverage,
scratching and clawing to raise four, right?
yeah, now leverage
Yeah.
is down, right? And they can only raise 3, 4 million. So now the size deal they can only buy is like 8 to 10. So that's having an effect on the market. But the institutional side is even worse because while they have money, or at least they claim to, they're more on the sidelines than private capital. And when I say at least they claim to have money, is yeah, maybe they have a $500 million fund, but and maybe that's fund seven. But if fund six is not performing that well, or let's say they're halfway through deploying fund seven, so they've put out 250, they have 250 of dry powder in fund seven, which is 500 million, but fund seven's not performing, they're not going to want to go to their LPs and say, "Hey, we're buying a new deal. We're going to make a capital call. Please fund, 20% of your commitment or 10% of your original commitment so that we can buy more deals," right? That's not as attractive. So even if the money is technically there, a lot of GPs don't want to call LP funds just for various reasons, right? But out of solidarity, etc. So that it creates an interesting opportunity on these institutional size and quality deals because the institutions are on the sidelines and these properties you might have to raise 10, 15, 20, $30 million of equity, and that is largely unattainable for many private buyers and syndicators. So it creates a nice sweet spot, right? There's a dearth of capital for these larger deals and the institutions aren't there for it. So that's creating an opportunity for groups like us to step up and play in a space that we normally wouldn't. But because we have the ability to still raise capital in this environment and we are willing to play in this lower risk space of core plus and not continue into the value. I'm not saying we're not doing value add, but this is just a way that we see the market right now and are taking advantage. So yeah, I think that makes it also a very unique time that I didn't want to
Yeah.
miss mentioning.
Yeah, no, absolutely. This is a very unique time, obviously, in the cycle. And even within the cycle, as there's a lot of discovery right now. There's discovery on pricing, there's discovery on, how much maybe worse will this get, or actually, are we kind of in the perfect timing right now, with things being slower inevitably with the holidays, but with, there being a nice spread now between cap rates and debt. This might not last forever. So we really want to be opportunistic here and just jump. And we've said this before, we'll say this again. We're not, going to be timing the market. We're going to be buying in all phases of it with, quality debt and equity structures to, withstand any storm coming. So we're really excited about this. And personally, it's gonna be fun to shoot some videos at Class A, products and, be owning stuff that we would probably actually want to live in because we darn well know that in 2, 3 years we might be having to go to maybe C plus B range assets. So this is exciting.
I agree. Anyway,
Yeah.
you think we covered that?
I think we covered it. Any other, I guess, nuance? I guess the other nuance I want to mention is that it seems as if the feedback we have received from, and this is just a nice macro tie-in here, to anyone who wants to have a lens into the institutional side of things. Some of the biggest feedback we have received was, hey, if we're going to do a deal, we prefer it to be 90s or 2000s. Now, that is all, a moving goalpost, but it seems to be the overwhelming feedback is 90s or newer right now. So if the institutional players are in play, it'll be a very nice test to see how they react to this potential new deal that we have coming up here. So that'll be exciting to see if they were just blowing smoke or if they were legitimate in saying, hey, this is what we look for, because we're really proud of some of the stuff we're looking at right now. And we're just excited to launch it to market to see how it does inevitably react to it. Moving forward to another topic, The importance of having a moat in your business plan. So if there's if it's really easy to get into something, naturally it could probably go away pretty quickly. So I would say with Lone Star Capital and just the multifamily space, inevitably there's only a certain deal size you can acquire, which can kind of handicap that kind of creates an inevitable moat there. But I would say one of the biggest moats that we have in our business model is the affordable structure that we have that is very challenging to navigate. But in your world, in your eyes, Rob, how would you kind of explain the importance of a moat in the business model? Meaning some sort of barriers of entry, some sort of, factor that makes it tough to play in it, and then also what would you describe Lone Star's moats in respect to what we provide?
So Warren Buffett and Charlie Munger talk about, rest in peace, by the way, talk about moats a lot, right? Warren says they're looking for businesses that are durable, that they understand, and that have a moat, right? A defensible moat. And what a moat is basically a way to fend off the competition, right? It's a differentiating factor, is really what it is. And the reality is as unique as one may think they are, they most likely are not, right? As unique as we think we are, right? There's a lot of groups that do exactly what we do. They buy multifamily in the Sun Belt, they buy multifamily in Texas, they do value add, they might even be vertically integrated,
They're
right?
looking for cap rate compression too.
Yeah, so there's a there's a lot of competition out in the world, right? The world's a competitive place, and so it's really, really important to have a moat. And so you kind of asked the first question, why is it important to have a moat? And that kind of is self-explanatory, right? You want to be able to compete in the market, but the other big thing is growth, because without a moat, every inch of growth or every percent of market share is a battle. And then it can be, like you said, it can be won, but then it can be easily lost. And so the goal of any business, right, is to grow, because the moment you stop growing, you're dying. And that's true as a business, that's true as a person, right? I think that's very true to you and I, our personal philosophies, right? We are always pushing ourselves in the gym, and we'll talk about your 3-day fast, which I'm excited to share with people. And I need to stop being lazy and do a 3-day fast myself. But right,
You have so much weight to lose. Yeah.
So, yeah, exactly. So there's that concept, right? If you're not growing, you're dying. And as a business with a moat, you actually, as you grow, it gets, in my opinion, easier to continue the growth, right? It's a momentum play. And so we talked about this last night, where we're just daydreaming about the growth of the company, where we're going to be in the future, and the reality that with every day, yeah, we're going to have new challenges, and we'll make our lives difficult because we'll seek out those challenges. But the reality is every day our lives will get easier because we're compounding our efforts. And if you want to continue the moat analogy, we're continuing to build up the moat. And so specifically, one moat that comes to mind is frankly what we're doing right now, which is producing content, being a thought leader, and establishing trust and credibility in the marketplace. That is probably, as cheesy as it sounds, right? Oh, podcasts, right? Or you wrote some books, right? But the reality is, in our business of investor relations and building a portfolio, it's all about relationships and it's all about trust. And it takes forever to build it, and you can lose it very fast. But it is a moat. So the stronger the relationships that we build with our investors, the harder it is for someone else to come around and take them. Not to say that it's a zero-sum game. I mean, we refer our investors to other people all the time that have complementary investment strategies. But frankly, I'm not going to be excited to refer one of our investors to someone who does exactly what we do, right? That's just silly. So the moat there is the trust between the partnership, right? So I think that's our biggest moat, frankly. I know you mentioned affordable housing, but that is I think the biggest one is trust, and it takes a long time to build, but it compounds on itself, right? Because it grows every year.
Well, the other thing that we hadn't mentioned is just time, and we're solving for that on multiple ends. There's some people who say we're way too, young. Both your principals aren't 40, so how could you possibly, understand real estate and the cycles and markets, despite how intelligent you may or may not be? But it's very interesting. I had Chris Larson on the other podcast under the Lone Star umbrella, Fun Friday, which is my other show if you want to listen to it. But Chris was on the show. Should probably air in a couple weeks, but he has three people and three groups that he works with. One of them, does multifamily in the Carolinas, also some car washes and, kind of interesting alternatives there. The other group is a kind of mobile home operator there, and then Lone Star Capital. So he mentioned that he met you 3 years ago. So what he was looking to solve for is time. That's a 3-year process of sending deals, no, 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 but being persistent and, us being smart to capitalize when the situation is correct with regards to the right opportunity, but also just timing and maintaining a solid social presence and whatnot. So time is the other, I guess you could say moat, but it's just a factor where all we can do is maximize the 24 hours of the day, and doing one-to-many forums like this where we're speaking, where we could spend 1 hour, where we could be talking to an investor, or 1 hour we're talking to, if we get 300 views on this, potentially 300 views of fund managers, potential LPs and whatnot who are spending their time and giving us their attention, which is such an important commodity this day. So it's very interesting that that's the angle you went there. But I really think with regards to Lone Star, that's a moat. Our track record creates a bit of a moat because if it's between us or Group B, but Group B's got no track record, well, who's going to win? It's probably going to be groups like us because you're just, you're taking a substantially larger risk, not working with, a more proven and dynamic and robust group like us in that respect. But the affordable housing is something that is special that not every group can navigate. And that moat is created because obviously you work with or we have a tax attorney, which who's a principal, Kent, who is the unsung hero at Lone Star, the person who wants to take zero credit for all the incredible things that we're doing here. But with his ability to understand the complications and the nuances regarding that, we get the ability to buy deals in times that's really not easy to buy deals in times like this. Like for instance, the $105 million acquisition we did was only possible due to that business moat that we had, and without that, we might have only bought 2 deals this year. So it's so interesting to think about that. And it is an important thing to think about, whatever your niche is. And also, I think you can create a moat around your business model by being very niche, right, and being very focused. So we're only Texas multifamily. If you are, a capital allocator, I've said this before, I believe, on this show, and I'll say it again, and I'll say it probably again and again and again. But if I was just Craig, who, has got a lot of rich friends from, a said country club, if that's, the type of person I was for a capital raiser, I would want to work with only a couple of people in that are super niche and focus in their submarket. And when they have a good deal, I know it's a good deal, not just someone who's buying all over the place. Then I can find diversity. But on our end, it would be very foolish if we were in 10 different locations, at least for where we are right now, right? So that's another thing to think about in regards to that. And we're only in 3 places for a reason, because we feel as if we can get the best investments possible, but also because we feel like we can navigate an affordable strategy in all these 3 places too. So it is beneficial to have those two sides of what we do, which is market rate deals and affordable deals.
It all connects well. And also, to use a visual example when talking about the moat analogy, right? The bigger your castle or kingdom, the bigger it is, the bigger the moat that you have to build, right, around it, right? So if you niche down and what your strategy is very small and specific, then your moat can be effective even if it's just a small little circle protecting your niche, right? So that's why I always preach to people when you're getting started, definitely be niche, focus on one strategy, right? When we got started, we were only looking at Houston multifamily value add. And so it was much easier for us to become known in that space, to become experts in that space, and to actually be effective in our execution in that space. And that speaks to another moat is vertical integration. The fact that we have property management and construction management in-house is a moat because while it's not terribly rare, there's a lot of groups that aren't. And so that's an easy differentiator to our competition. And so just as an example, the fact that the new deal that we're buying right now in Houston, we own 1,000 units in a 10-mile radius. We own another couple of deals here and there, right? So we already own in the area, and that's a much more compelling story. So that's another moat, absolutely, right? And because it helps in all angles. The seller is more comfortable in awarding us the deal if we own deals down the road. The broker is more comfortable awarding us the deal if we have that relationship and that presence, which we wouldn't otherwise have if we weren't focused in that niche. So all that really helps. And then I think the one thing I really like that you said is time. Time is absolutely a moat builder because if our track record spans 10 years, that is a moat in itself, right? That makes it hard for people to deny us and to not want to work with us as compared to a group that might have 2, 3, 5 years of track record. It's a big moat that takes a literally time to build, right? It doesn't matter how amazing you are. That moat only takes time. So that's a really valuable one that I like that you mentioned that.
Awesome. Any other final thoughts there?
Well, to hit on the affordable side, because I know we kind of, or at least I breezed past it, but yeah, the affordable strategies that we employ are extremely valuable because they are differentiating and unique. So if there's only a few groups that have the knowledge and wherewithal to pull off certain strategies, that's a moat in itself. Because it generates alpha, it allows us to generate outsized returns, perhaps, or like you said, to make deals work in an environment where deals don't work, let's just say as an example. So, not to get into too specifics as far as the affordable housing programs that we do, it just gives you another tool in your tool belt to provide flexibility, more opportunity to create unique value that otherwise isn't possible.
I love it. Brokers pushing lender relationships.
Okay, I like this
So
topic. Go
this is
ahead.
something that in every form of real estate exists. When I was selling a house, this was happening, and on your world or in our world, it happens all the time. Hey, brokerage over here wants to award you the deal, but hey, can you use our in-house lender, right? So this is very common with, kind of getting, alignment in regards to, fees created with title, lender, escrow, the whole nine. But why don't you explain kind of the dynamic in our space and whatnot? And by the way, we get hit up for lending stuff all the time on LinkedIn. Don't. We're not going to use you. I want to be as transparent and as kind as possible here, but I don't want to be kind here. We're not going to use you for lending. We're good. So, with that said,
Yeah, so a recent trend in the industry is not necessarily consolidation per se, but I guess complementary fee streams. And so what we've seen a lot is lending shops will buy a brokerage or partner with a brokerage firm. And then brokerage firms now have an integrated lending platform. And so when a broker is selling a deal, they'll push their debt team to finance the deal on behalf of the buyer. And it's a very complementary thing. It makes a ton of sense, right? We're selling the deal for you. You can finance with our team. And then there's sharing of fees there. There's kickbacks, meaning between the sales broker to the debt broker, and it could even be vice versa. But
depending upon who maybe sources it or the relationships
right.
associated with the
So
potential.
having
Yeah.
that connected and plugged in is really complementary, and I understand what it's doing, but it's creating a lot of complications and difficult situations in the business because now a broker that's selling a deal might have the incentive to award a property to buyer number one versus buyer number two because buyer number one is working with their debt team, whereas buyer number two isn't, right? So and brokers will say, well, I'm not going to have that influence my decision. And that could be true because the kickback that the broker is going to get is not necessarily going to be that substantial, right? So they'd, at the end of the day, rather pick the best buyer, number one, over where they can maybe squeeze out the most fees. But we're seeing this all across the industry. Uh, you know, Greystone and Cushman Wakefield together. What are some other big recent ones?
Yeah, and while you think of the recent ones, just something to think about is you get kudos from your offers managers, and typically the way this works is, brokers, typically don't have, they typically have a good amount of autonomy, but they do respond to someone. And what will happen in these office meetings, typically speaking, from someone on the brokerage side, is they'll have their lender people come in and they will kind of hound you saying, "Hey, push our ancillary services onto, this deal to tie up and tether as many fees as possible because it's in-house. And they'll probably sell you on, oh, well, it's so easy, and you'll have control, we'll have insights, we'll help you out more. And maybe for some people, depending upon where you're at in your syndication career, if you are in fact an operator, that could be useful. But on our ends, we have such a good relationship with our debt provider. Shout out Nate Lowy, who just gets us what we think is just the most competitive terms time and time again, and really knows us. And on our end, we probably don't want to give out much more of our personal information on the debt sheets that are the bank sheets and such to a ton of people. So we probably prefer to keep it there. But we do understand sometimes that some of these deals are kind of handicapped and handcuffed contingent upon the debt. And if we have to do that, we might, but we prefer to have our own autonomy there.
Definitely. And yeah, you're bringing up the next important factor, which is this creates risk because firstly, it creates execution risk. If you, let's say, in an effort to win a deal, you sweeten up your offer by promising to work with the corresponding debt team, you might be working with a team that you haven't worked with before. They might not be as familiar with you or your business plan, or the communication might be off or something, and there could be some breakdown there that results in getting less than optimal terms on the debt. All right, or maybe there's a delay because of just kind of getting things going there. Right. If you have a
They may not be even be incentivized because they might say, "Oh well, I have this business locked up. I don't have to give them that great of service." Versus someone like us coming up and kind of cold approaching us saying, "Hey, with an opportunity with debt, they're going to be working their face off to kind of ensure the business." But when the dynamic is set as such where it's kind of just a gimme, well, maybe that person's not incentivized enough. So that's kind of the risk that we're kind of getting open to in the event that we don't use our in-house people, or at least kind of put some pressure on them to provide the best terms and to give us the best service possible through our transaction.
That's certainly possible as well. Yeah, that's a good point. So those are the execution risks. Whereas compared, if you have a consistent lending relationship, they are going to have your financials on hand and they can update them with you. So that's going to be more seamless. You're going to be able to just make things happen more smoothly, right? Like with anything, having repeat business, having repeat partnerships is really, really valuable. So that's one element. There's another element, which is actually quite crazy and somewhat unique to our industry because we have the government-sponsored enterprises, which are the agencies, Fannie Mae and Freddie Mac. The way that that works is you have delegated underwriting and servicing lenders that basically underwrite, originate, and service loans on behalf of those agencies. So you have Northmark, you have Berkadia, you have Greystone, and they all issue loans for Fannie Mae and Freddie Mac. So, but at the end of the day, those are Fannie and Freddie loans. And so Fannie and Freddie is going to look at those loans and they're going to have to approve those loans. And so some feedback that we've gotten in the industry is things can get a little prickly over here because if you are working with Northmark, but then also Berkadia, and then also Capital One, and then also Newmark, and then Freddie Mac or Fannie Mae is receiving your deal or your deals that you're doing consecutively from these different sources, it makes them a little nervous. They go, "Why are you working with so many different groups?" And then also, think about this. It's very hard to keep all your documents consistent if you're working with all these different shops. So now all of a sudden, Freddie is getting your docs from Newmark, your docs from Northmark, and from Berkadia, and they look a little different. That causes them to be a little bit concerned, and that can create that can create some issues there. So it's kind of paradoxical because here Fannie and Freddie they've set up this system where they have lenders that underwrite and issue debt on their behalf. There's been this play of consolidation in the market where now the lenders to win business are buying brokerage shops to then control where the debt business goes. So now as a buyer, you're more beholden to more lending groups because you want to work with different groups depending on what's optimal for that relationship, for that market, for that deal. So it causes you to work with more, right? I'd have to imagine that we're seeing buyers are working with more lenders than they would ordinarily work with because of this new competitive dynamic in the industry. And frankly, on the other hand, it's anti-competitive because, right, you're forced to use perhaps the sales team's debt shop rather than using who you want or rather than creating a competitive market for the business. So it's competitive or anti-competitive depending on which way you look at it, but it creates this more confusing and more risky thing from the Freddie Mac Fannie Mae side. And as we talked about a few weeks ago on the show, Freddie came out and kind of put a big X on Meridian Capital, and Meridian's a debt broker. So now we have another layer of complexity in the business, right? We have the debt broker who sources the DUS lender, who then originates the loan on behalf of Fannie and Freddie. So we actually have three entities involved vis-a-vis the borrower, right? You have the borrower who just wants some debt. They have to go to a debt broker, who then goes to a delegated underwriting and servicing lender, who then originates the loan on behalf of an agency, right? That's the chain of command here. And as you could understand, a lot can break down here, especially if that chain is being interrupted or being, or there's multiple chains that a borrower has to work with, right? And so speaking of the Freddie scandal with Meridian, nobody can, I mean, I don't know the matter too well, and I don't know what the latest is, so I don't want to speak out of school, but from my understanding, right, if you can't use Meridian to go and get a Freddie loan right now, no matter what DUS lender or a seller servicer, which is the correct term for Freddie. So no matter what seller servicer Meridian takes you to, they're not gonna be able to get you a Freddie loan. Freddie's just saying, nope, we're not doing any Meridian deals, right? So that's causing an issue all throughout the chain, and it's causing DUS lenders and seller servicers to make the case, hey, don't use a broker. You see what happened with Meridian? They cause problems. Just go direct to us, right? And they want that direct business because they much rather work directly with a borrower because a
Yeah.
borrower doesn't negotiate as hard as a broker because a broker like ours, like Nate Lowy at Juniper Capital, he knows
Shout out Nate. He's the best. He'll be on the show at some point. We'll get him on here
we
because
shouldn't be shouting him out because we don't
yeah,
need him to get any more business because he'll give us worse service.
right.
But anyway, I'm just kidding, but
Yeah.
not really. So like Nate's gonna agree. Nate knows the market better than we do, and he's gonna negotiate harder than we can. So that's why a lender doesn't want to work with a broker in between with the borrower, right? They just want to keep it simple. Everything's good. They don't want to get their fees compressed and stuff like that. So those are the dynamics and the realities. And here we have kind of this unintended consequence associated with Fannie and Freddie just being Fannie and Freddie, right? They're big government bureaucratic agencies, and they have these. They're a bit prickly. They have these certain policies, and you don't want to get on the wrong foot with them. And right now, we've seen Meridian get on the wrong foot with them, and that's causing a lot of problems in the industry. And we're living it day by day. So I don't know. I don't know what the takeaway is, but it's an interesting time, and there's always fun stuff like this happening in the market that we need to be cognizant of and navigating around.
No, it's a good breakdown. It's a nice little nuance to those who may not be privy to the insights of the inner workings of the business. It's a behind the curtain topic, excuse me, which is always fun to dive into. And it's just interesting, you get pitched all the time on lending deals, and my favorite is when someone who does allegedly does equity but debt primarily. It's like, well, we can give you equity, but you have to do $100 million plus the loans. Oh, interesting. So that's probably my least favorite shakeup, if you will. Don't do that. You'll be on my shit, my you know what list right away. So yeah. Whew. Well, with that said, I did a very interesting activity over the last week, which was a 3-day fast. So this wasn't the longest fast that I've ever done before. I've done a 4-day fast, which I grinded out with you in New York City. Yes, I did in fact feel so bad about myself following all the great meals we had from Carbone, this, that, back in April of 2023, that I had to do a 4-day fast to really cleanse myself and my sins and my palate and to get cell autophagy. But I just did it as well over the weekend, and it was great. And I actually have a goal that I want to put out in the universe and speak to everyone, hold me accountable in this. But my goal in 2024 is to do 4 3-day fasts minimum. So it could be a 5-day, it could be this, it could be that, but it has to at least be 3 days. So
Very nice. I love that goal. And I want to do a 3-day fast in 2024. I should get it done sooner rather than later. Let's talk about the specifics because you mentioned cell autophagy. That's really important. That's why I'm interested because you're interested in autophagy, which is basically where your cells clean themselves out, and it's really good for cleaning out potentially precancerous cells, and it really helps with
Prevents
preventing
helping Alzheimer's, basically
Alzheimer's,
effectively.
dementia, cancer. Really exciting. But obviously, also, when you don't eat for 3 days, you're going to lose a lot of weight. So it's a great weight loss strategy. It's kind of, maybe perhaps like bingy, right? Like maybe some people think, oh, well, you overeat and then you starve yourself,
Don't.
right? That could be
Yeah.
perceived as unhealthy. But uh, I mean, there are, it resets your metabolism and the cell autophagy.
Yeah, no, it's really a really cool process. It's what I found is that you feel very alert. You've got waves where you're really dead and then they'll kind of come up. And what I do is I have these on my desk all the time. You'll see these are kind of my coffees, these are my cold brews. Not enough calories in here to definitively break a fast. It's just basically black coffee. And if you're a Kirkland Costco person, these are great. I recommend them. Not the tastiest, but gets the job done. Don't want to pay excess or stupid money to premium coffees. Not a good efficient use of dollars. But effectively, I did it with electrolytes, which had no sugars or carbs, just enough to keep body process going well, and then bone broth coupled with that. So the first day was only water. The next day was basically electrolytes with most of my water that I had. And then I think I had bone broth in day one, and then bone broth in day two, and then day three I also had bone broth. But the dopamine rush that you get from eating food after not eating for a couple days is pretty wild, and it's definitely something I recommend. One thing I want to get better on is being more active during the fast to really accelerate my autophagy process, because you're just burning through the sugars, the glycogen storages that you have in there, and you're basically just depleting more dead cells in your body and kind of other just junk that's sitting, it's sludge. So you really are effectively cleaning out the sludge and the inner workings of your system. It just turns over cells. I mean, as you mentioned, the health benefits are one thing, but it's also a mindset thing too. I thought it was very interesting on All In, the All In podcast, which we're obviously big fans of. Our friends are. It's funny. We have a group text with your dad, with our good friend Teddy, and you and myself, of course, with basically just All In content, effectively, which is super funny. But in society that we're in right now, it seems as if the more prosperous you get, there's studies that show that there's increase of diabetes and heart disease. So. I have a very, very privileged and fortunate life. So every now and then it is nice to force myself into something that's not pleasant. Not because that's the only reason I like to do it, but that's also an unseen benefit to the fast is just the mental toughness and grit associated with it. Because when you do accomplish something like that, listen, it's not easy. It's funny, losing weight, it's actually not hard, but it's the easiest thing to conceptually figure out. But it's one of the hardest things to actually do. I love French fries. I love basically anything that tastes bad or tastes good that is bad for you. I love. I've struggled with my weight a lot. For people who haven't listened to every show, but know me personally, I lost 110 pounds my senior year of high school in an 8 month stretch. So from September 2011 to May of 2012, I lost the weight, and I've kept off basically every single pound that I've lost, which is really cool. So it's one thing to lose weight, but you got to keep it off, most importantly. So I did, in fact, do that, which is awesome. But yeah, this is going to be something that I want to do is routine health maintenance for, keeping my weight at the said number I would like to be. I'm about 185 pounds right now. I'm 6'3", 185, and a legit 6'3". Some of my friends want me to say that I'm 6'4". They'll go nameless, or 6'5", but I am, in fact, 6'3" on the dot. Shoes off, hair down, 6'3", as
At the
legit at
doctor's
6'3".
office.
Exactly. At the doctor's office, if I was weighing in, listen, maybe if I played for, the Arizona Cardinals or the New York Jets, they might list me at 6'4" and a half, 6'5", but that's not my true playing height. So,
So yeah, the mental side is really fascinating, and I think what would be really cool to do would be a 3-day fast coupled with a phone detox. You could take a
ooh,
long weekend where you don't eat
yes.
and you don't go on your phone. That would be insane.
So that would be a dopamine reset entirely. And, frankly, it's funny. That would make that fast feel a lot longer. I think the only way you could actually do that is if we were together perhaps you, me, and a couple other buddies where we were in, an isolated environment, perhaps Sedona, which we're having a Sedona trip planned out here, following Race Fest. But maybe perhaps if we ever get a good group of guys together to my family's place in Oregon and Bend, that could be a lot of fun as well to kind of do it there. Although the issue with doing it Bend is there's such great, delicious food. There's a foodie scene there for sure. So it would be tough to turn that up. But it's definitely something that I encourage all people who are listening to the show to think about. I think what inspired me to do this as well was, and I'm sure some people can relate to this or remember this, but the Dana White post with regards to this, he basically posted his kind of results after he looked absolutely shredded, and he actually did or was kind of close to being close to death with regards to his health. Which is really sad. His blood sugar levels are really high. Gary Brecka was on the Joe Rogan podcast that kind of broke it out. So this is all public information, of course, but effectively kind of reset his body, his cells, and whatnot. So this is just a great way to stay healthy, to be healthy, mental clarity, sharpness, just so many benefits. So if you are interested in learning about more than just real estate, but my 3-day fast experience, or want tips or advice as to get it going, let me know. Email me at craig@lscre.com for any information there. If you've ever done a fast, never even done a 24-hour fast, start there. I will say, someone like myself, you kind of laugh about this. You could go all day without eating. I need to eat, kind of get going. And then I'm better off, or will perform best. And you'd probably want me to do it this way, but I like to eat around, call it 11 to 1 p.m., or maybe around call it that noon slot, and then I just won't eat at night, and then I'll just wait through the day. That's what's best for me. But some people get incredibly hungry at night or want to eat at night. More power to you. Whatever works for you. Maybe you want to eat in the morning and just not eat all day. Totally fine. But effectively, if you are looking to lose weight, I will say you got to go to bed hungry. So that's the only way really to do it, unfortunately.
Yeah, and that's nice while you're sleeping to you get some autophagy going there and whatnot. But anyway, that's an interesting topic. You and I are big on the health stuff, so I'm sure we'll talk about more health stuff in future episodes, like red light panels and whatever else we're doing. I'm cold plunging tonight after boxing, so that's gonna be fun.
I could go cold plunge in my pool in the backyard, considering it's about 55, 50 degrees right now.
Yeah, that's not bad. Mine will be 42.
Yeah, 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 yeah. Well, mine's baked into the cost of the house, right?
Very good. Very good.
Yeah.
All right. Do we have any other topics?
No, it's on to Watch Talk, which we do apologize for neglecting. We want to make it real estate based and have a little more watch rhetoric mixed into the palette here on the show. But we do have something fun here that Robbie wanted to speak on. A very beautiful, more rare piece for sure. I would say if you saw 400 day dates, there might be a chance you actually, in live, like in real life, walking around Vegas, Miami, maybe Miami, you'd see this. But if you're just were to see 400 day dates, you may not actually see this piece. So why don't you show it, unveil it, and break it out? Maybe give the reference number.
I actually don't even know the reference number on this, to be honest with you,
Yeah.
but this is a platinum green dial day date.
Presidential.
Right. Presidential bracelet, the classic bracelet on the day date. And then what really separates this is the Arabic written numerals, which
Yeah.
as you
And,
see here.
and I actually want to show out, and this is something that people don't necessarily realize. So I'm going to throw my piece up. So mine is a Jubilee bracelet. As you can see, the Jubilee bracelet and the presidential bracelet do look slightly different. They look really beautiful in the light, of course, but you can kind of see the width right there on the Jubilee as opposed to the presidential. So just a little distinction right there while we have them both up. You can kind of look at that. And it's kind of interesting. I always thought, and you actually knew the history very well of this. So I always was under the impression that if Rolex made a platinum piece, it was always that ice blue, right? However, this piece doesn't have that. Additionally, it is interesting to see a non-fluted bezel for this particular day date as well, because the fluted bezel, which for those who don't know, it has the kind of the crinkle to it. A lot of date justs have them. It really, when the light hits it, it reflects very nicely, so it'll kind of pop and catch your eye a bit if it's light pops on it. So can you kind of give the history as to why this piece is, the olive green color or mint green? Is it olive or mint green?
I would say this is an olive. And so
Mm,
anything green right now is super hot. So I would say
hmm
in 2020, and then
2021.
really in 2021, blue dials were it. And they were going crazy. And that was culminated or epitomized by the Patek Philippe 170-year Tiffany anniversary piece, which was the 5711 steel Nautilus with the Tiffany blue dial. That watch was famously sold at auction, one of the first ones at 6 million. It's a very rare piece, objectively rare at only 170 pieces to represent the 170-year relationship that Tiffany and Patek have. And now that watch has come down. I mean, 6 million was a bit ridiculous, but that piece has come down to maybe about 2.5 million in value, kind of hovering in the mid to high twos. So yeah, blue dials were it. And then this is crazy. Then we always had, not always, but we had the olive green dial rose gold day date, which is known as the anniversary
Mm,
day date, right? Which has this green dial. And so that's a very desired piece, and particularly that
gorgeous.
green, right? So green dials started to pick up a lot of steam. So anything green would just catch fire and be very popular. And I would say culminated, if you will, again, or epitomized by another Patek Philippe Nautilus, but the final, this was what was interesting. Patek announced that were discontinuing the 5711, which was at the time and still is pretty much the most popular watch on the planet, right? It's a Nautilus, which actually this is a Nautilus, but this is not a 5711. And so they said we're done with the 5711. It's been a good run. We're discontinuing it, but they made a couple more. And one of them that they did make was for the first time ever, they did a green dial on a Nautilus. And that watch is going crazy. Believe it or not, that watch is worth maybe around 300K right now for a steel Nautilus with the green dial. You can buy a white dial Nautilus for less than $100,000. Just swapping the dial can 3x the price on this piece. So that speaks to the hype around green dials right now. So
And
hype.
by the way, speaking of green dial or green faced watches, two of the most beautiful watches for the price is the watch Teddy has, of course, which is the Jubilee, Datejust Jubilee,
Mint green
fluted
dial.
bezel, mint green. And then also to be noted and very unique, very uncommon to see. Well, unique, inherently uncommon to see, but is the Sky Dweller with the Jubilee bracelet with the mint green face. This is gorgeous. I mean, I'm talking about, when we first saw it, the Sky Dweller is the most complex Rolex that they make due to, it having
It's an
the
annual calendar.
yeah, annual calendar. You got the month. A really, really unique piece. So, of course, Chris Boakes has got one with the white face, and then the black face one's also gorgeous too. But the Sky Dweller for the right piece, the Sky Dweller really is gorgeous. It's just for gentlemen like myself who've got smaller wrists. The Sky Dweller probably be a little too big of a profile for someone like me. And unfortunately, I love the Explorer 2. I think Explorer 2 is one of the finest pieces for the price too. It's probably around 11-ish grand. For new, there's not much of a spread there on retail to aftermarket. Beautiful piece, but for my just small little wrists, I mean, this 40 looks huge. So really, really pretty piece.
Yeah, I agree with all those sentiments. Yeah, green is my favorite color, frankly. So, but like you pointed out, Rolex, to my knowledge, has, I don't want to say never, because I just don't know the history that well, but I don't think they've really ever done a non-ice blue dial on a platinum piece, right? That really signifies to people and to watch collectors and to the public that, okay, this right here, this isn't, imagine this is an ice blue dial,
Because you
right?
would think that's white gold, just
Yeah,
inherently with,
right,
yeah, you'd
exactly.
say, hey, this is the day date that must be white gold, but it's platinum.
Only the trained eye, if even a trained eye could tell that this is platinum over white gold, because there's variations of white gold,
Well,
because a lot of white gold is rhodium plated, frankly, to look like brighter like this, like platinum. But true white gold is actually no, better known, not better, but also known as gray gold, and it's quite gray as compared to this right here.
let me ask you something. So, do you feel as if they're with a piece like that, because it has Arabic dial. Arabic typically means, if you read that, you speak that, you could be Muslim, right? Muslim people don't wear gold. So do you think they made this piece platinum to accommodate the Muslim community and buyers that wear, gorgeous pieces like that potentially? Do you think that might give a little lens as to why they did it like that? Or
That's a good point. I've never thought of that, but I can't think of any
are we
Arabic
connecting
written.
some dots?
Yeah, I can't think of any Arabic written dials that are gold, right? Because gold is Muslims. I mean, I guess the most religious Muslims don't wear gold, right?
Yeah, very, very
Men
practicing, and I don't
men at
know the
least
levels to it. Yeah, exactly. I don't know the
for a
levels
man.
to it. Yeah, exactly. Okay, yes, and I don't know the levels. I'm speaking at a slightly place of ignorance here, so don't want to offend
But it's a
anyone
good
who's
point.
super into it. But if I'm wrong, please let me know. More than open to your feedback. Once again, email me any questions you may have, mailbags, questions you have at craig@lscre.com for the a millionth time on this show.
Okay, so uh, and also like you're talking about, the Arabic written numerals. These watches that have these limited dials you can only get in the Middle East, right? So they are very rare to have the Arabic written. It's not like you just walk in and say, "Yeah, I'll take the Arabic dial, please." That's not just an
No.
option that you check on the Rolex site, right? So that's something interesting.
This is
Oh,
not configure. This is not configuring a BMW 3 Series on the internet when there's a ton of inventory, not a chip shortage.
exactly. And then also we actually didn't introduce this watch appropriately because the reason why I'm holding it in my hands today is because we have the privilege of being able to borrow it from our good friend and investor, who we won't name just because we didn't ask for approval or anything. So yeah, that's why we have it here. This is not a piece that's in our inventory or collection. It's not for sale. I mean, probably everything has a price. So if you're dying for this watch, reach out to us. Maybe we can broker you a deal. It's not anything in it for us, but just to
For the
you
love
know,
of the game.
I love the game, our sickness of watches. So, and then the other notable thing too, not to get political, but it's very funny actually that I think it's very funny. Our friend that owns this watch is Jewish, right? So it's an Arabic written uh, dial, but the owner is Jewish. So I don't want to get political on this show, but what I will tell you is that we are unapologetically pro multifamily real estate in Texas with Lone Star Capital.
And we're
So
also pro Rolex and Patek Philippe, if you're wondering. This is a pro Patek Philippe and Rolex show. Audemars
that
Piguet, I'm on the fence about if someone wants to gift me an Audemars Piguet or let me wear theirs for an extended period of time on their insurance time. I'm more than happy to sample the goods and the products. I wouldn't mind a Royal Oak. I wouldn't. So if you want to send one my way, more than happy with it.
Yeah, I agree with that. I mean, a lot of people love AP. We'll just leave it at that. So the last thing I want to comment about this, and then I think we can wrap unless there's anything else, is as you called out, the smooth, also known
Mm-hmm.
as the domed bezel. Okay.
Mm-hmm.
So this is different than the Jubilee. I'm sorry, not the Jubilee, the fluted bezel that we spoke a lot about because both you and
Yes.
I like the Jubilee. Gosh, the fluted bezel. Yeah,
Jubilee.
that's a Jubilee. So the fluted bezel, you get a lot of bang for your buck because it has all these cuts into the bezel, which makes it really shine. No diamonds, but it's really flashy. However, what that means is maybe if you don't want some flash, this is much more quiet. This is smooth. It really kind of flows nicely. But also, what's really notable about this is the fact that Rolex up until 2022 never not did, couldn't. They couldn't produce a platinum watch with a fluted bezel. It was too challenging to work with the platinum that they work with. Also, Rolex notably is the only major watchmaker that has its own foundry and makes its own metal. They make their own gold, they make their own platinum. So that's very special on Rolex's end. But they up until 2022 couldn't figure out a way to make a fluted bezel in platinum. So all their platinum pieces had to come with a smooth bezel. So it was kind of a giveaway, right? If it was a date 8 with the ice blue and with the smooth bezel, oh, that's a platinum piece, right? And for those that don't know, platinum is the rarest, the most expensive metal.
And
Not necessarily
certainly the heaviest.
very heavy. And it's not necessarily
And
expensive as in like, oh, look up the spot price of platinum per ounce versus gold per ounce. It's more expensive because of how much platinum you have to use to to actually make the watch and also how difficult it is to work with. Platinum is much more difficult. So it
Less malleable.
takes I'm not sure exactly what it is, but it takes something like 10x the man hours to produce a platinum watch than a gold watch. It's just much more difficult. So, but like I said, 2022 was the first year where they actually figured out a way to make the fluted bezel. So now you could enjoy a platinum date 8 with a fluted bezel with an ice blue dial. And I think they do make this watch with the fluted bezel. So there's a
So a
lot
very
to love.
trained and a very trained and acute eye would be able to tell if you were really in the weeds in the Rolex world, the exact nuance associated with that watch with regards to the time and such.
Yeah, absolutely. That's exactly right. So that pretty much wraps it up for me. I don't know if you have anything else that we wanted to highlight as far as watch talk. I'm glad that we brought it back. I know that people have been writing to us saying, "Hey, we love when you talk about watches. Do some more." But at the same time,
Shout out to my boys in DC who I just spoke with, who mentioned that they did in fact also like the watch talk. So we will do what we can to accommodate that and to bring it back where we see it fit without having it be too gaudy and overzealous and tacky, if you will. So we want to gracefully put it in there in the most tasteful manner, of course. Uh,
yeah,
and we'll
that's a good point.
also,
If I can just comment on that, I think that's a concern of ours is we don't want people to tune into this and get the wrong idea like, oh, they're flashing or flexing their watches or what are they doing? I don't get it. And so I totally could understand why somebody who isn't a part of doesn't have a watch illness like we do and isn't in the kind of the watch world, how they could find that to be off-putting. And so I think we are careful of that. And we don't want to come across as that, right? Because we're not showing off. We are indulging in the hobby and talking shop and everything like that. So
and
we
we're
want to,
grateful for the opportunity be successful to have, a really cool wrist piece. And we hope everyone gets to that point. And, the biggest thing is we're people too. We have insecurities, we have issues, we have ups, we have downs. We want to share wins with you. We want to keep it
but there's no
positive.
downs with a Rolex or Patty on your wrist.
That's true. Your day is a little brighter, which is just completely counterintuitive to the points we're just making. But no, I'm just kidding. But we want to be very gracious and don't want to be in anyone's face about anything and at all. And yeah, so but we're just really excited to share this, to share our love with everyone. Hopefully, you see how sincere and excited we get. I am really excited too because it's almost the end of the year, which means Rolex will announce its newest pieces. Last year, we got gifted and blessed with the whole 1908 piece, which was a new line of Rolex. So very curious to see what will come out and the new options for maybe anniversary pieces and everything else in between for the new line of inventory that you'll be able to see at Rolex, but won't be able to buy, of course. So that'll be interesting. With that said, once more, we're going to be at NMHC at the end of January in San Diego. If you are an equity provider, an LP or JV or fund manager that wants to meet with us, please reach out to me. You know my email. Once more, it's craig@lserie.com. We'll also be in Houston, in San Antonio, the second week of January. So the week following New Year's week and such. January 7th to the 11th, we'll be out there. Don't be a stranger. Maybe hit us up. Maybe we'll do a meetup actually and do some cigars somewhere, investor dinner, the whole nine, potential partner dinner because we'll be touring a couple of our properties that we have under LOI. Very exciting. If you're a fund manager, 1031 exchange, looking to partner with Lone Star Capital, looking to tether your wagons to a great group like us, please call me, text me, email me. You know the drill. Craig@lscre.com. We will see you in the next time. We thank you so much for listening. Happy Hanukkah to our friends who are celebrating all the other holidays. Merry Christmas almost. And we look forward to catching you on episode 27. Peace.